in the last 30 days, our pension plan return assumptions have been crushed. We basically lived out our entire forward-looking projections in 30 days. So, as a sponsor, what should I be doing right now thinking about my forward-looking return expectations?
Yeah, it's the game has definitely changed, even since 6 weeks ago, in terms of where a plan's funded status or deficit may be. When we think about pension plan deficits, uh, there are really only two ways to close those. One being generating investment returns above and beyond the liability, and the other being contributions into the plan. So, if this market turmoil has significantly impacted funded status, that could lead to a very worthwhile review of the plan's management strategy. Is this an opportunity to turn down that pension relief and maybe make additional contributions into the plan? Is this an opportunity to adjust our risk posture? Most major asset classes are 20% cheaper than they were 6 years ago or six weeks ago. Is this an opportunity to update the investment of the portfolio accordingly?
Right. I mean, the S&P was down 34% from the high just 6 weeks ago, and now I'm sitting here thinking about my asset allocation, and perhaps not only should I be rebalancing, but perhaps I should be shifting risk away from fixed income into equities, especially if I'm underfunded and don't have the means to contribute my way out of the deficit. I could take more investment risk with the potential expected returns being much higher going forward, or at least in the near term. Is that an accurate assessment?
Yeah, I think that's fair. And if you're in a position where you're looking to improve funded status, fortunately, from an accounting perspective, that threshold is still pretty low. Discount rates hovering around 3%, meaning if your portfolio returns more than 3%, you got a good chance at improving your funded status into the future.
And is it fair to say that given the Fed's monumental actions here and their presence in the bond market, that they're basically going to crowd everybody out of the bond market and force me as a pension investor to buy equities in the future?
That that's certainly their goal. I don't know if they would come out and say that, but that's kind of the underlying assumption when the Fed cuts rates to zero, starts buying high quality corporate bonds. Their goal is to get investors out on the risk spectrum. So now, if I'm a pension plan sponsor and I see, corporate bonds are only yielding me 3%, that makes it a little bit easier to get into U.S. equities, foreign equities, high yield bonds. That threshold for investing in those asset classes relative to my liability continues to get lower.
Right. And just thinking about, you can buy dividend paying stocks that are paying you dividends of 5-6% before the buyback yields. So there's opportunity there to get income that would be relative to your bond proxy. Additionally, this also pretty much, without saying guarantees, it pretty much says to sponsors that interest rates are probably going to be low for a very long time, which means your liabilities will continue to stay where they are, or perhaps even grow a little bit because the rates will not go back up in the near term. Is that a fair statement also?
Yeah, it's tough to see long-term interest rates rising significantly from here. With the Fed's activity in not only Treasury and mortgage-backed bond markets, but now also corporate bond markets, not to mention the historical fiscal stimulus that was recently passed. It's in the Fed's best interest, it's in Congress's best interest to keep interest rates low for quite some time.